That Barry Habib, President and CEO of MBS Highway, has taken the time to share this announcement with us, or share these market updates with us. Obviously, we've all seen some pretty dramatic changes in the market in the last 24 hours. So I'm going to hand it over to the man himself, Barry Habib. Barry, welcome, and thank you for taking the time to share this information with the loan originator community.
Hey, well, thank you, Anthony. And I think I speak for everyone when we say you have been kind of round the clock trying to get information to everybody. I think we all appreciate you. You've been just such a great leader through all this, and the interviews that you've been doing have been really insightful. I watched the one that you did yesterday with the Kevin Perenio, and we all love KP. I mean, he's wonderful. So I thought that was great. I think all the ones that you're doing are great. They're very, very helpful. So I just wanted to start off by saying thank you for what you're doing.
And same to you, because you are you're helping tens of thousands of loan originators prepare their consumers, prepare their realtors for this crisis. And to be honest with you, there's a major drop off after you when it comes to thought leadership at this time. So thank you. I know I speak on behalf of at least my community of brokers and loan originators that we're all, in awe of how you've been going 24/7 and really bringing us valuable information.
Thanks, brother.
So, where should we get started? I mean, I feel like we only talked last Tuesday or Monday, but it feels like that was like 10 years ago. So where would you say the best places to get started? Knowing that right now the Dow is currently up 1,700 points. The 10-year Treasury's up. I'm sure that's having a big impact on interest rates.
So I'll leave it to you. We could start with the stock market. We can talk about housing. We could talk about rates, and then we can talk about the outlook for some of the challenges that these both government instituted initiatives as well as the volatility in the market have presented for everyone out there and the companies that we work for or we send loans to. So I'll leave it to you, Anthony, or whatever the individuals watching would like us to address first. So you take it.
Yeah, let's get started with, and because we have plenty of time to get into the interest rate environment and how that's going. But let's start with the actual market, the stock market, because you've actually given me a lot of really, really sharp advice in that area, and you've been on point just as much as you are with the rate market with that market. So let's talk about what's going on there.
Well, I think what I did yesterday, right? Which I used yesterday as an entry point. I just said that I think that there's a reason that the markets will rally tomorrow, and I entered yesterday in a pretty meaningful way. And at least right now, it appears that I was for now on the right side of the trade. I mean, who knows what happens, right? But I'll give you my reasons for that, and they're entrenched in both fundamental ways. So first is I feel that we are somewhat imminent to see a deal put place that's going to be a stimulus aid package, because we desperately need that. Now, there's going to be some ramifications for this and fallout, but the other one really is the fundamental of this entire crisis. So this is very different than 2008. You can't really compare it because, as you know, Anthony, in 2008, that was a demand issue. There's plenty of demand today, but we are forced to shut our economy down. And it's all because of this virus, and we're trying to do the right thing. So when we talk about the term that everyone has heard, and that is flatten the curve, everybody's heard that term. Why? So just to kind of give you in some scary terms first, and I apologize for doing this, but we just have to be realistic about this. The virus spread in the United States is doubling every 2 days. So it was 30,000 cases going to 45, going to 60 tomorrow. So, 2 days ago is 30, 45 today, 60 tomorrow, which means, today being the 24th of the month, if you take it to the 26th and maybe we go to 120,000, I'm sorry, the 27th would take us to 120,000 cases, which means the 29th is, a 250,000. The end of this month, 500,000. April 2nd is 1 million. April 4th is 2 million. April 6th is 8 million. April 8th is 16, and April 10th, it is 10% of the United States population that will be affected by this as an individual, which is really scary. And that's why flatten the curve is something that everybody is talking about, because we have to get that down. Now, as you know, I've been in constant contact with Mike Royce and the head of the Cleveland Clinic, and Mike and I spoke today before this call because I wanted to be prepared with the latest information for you. So Columbia Presbyterian, New York Columbia in New York City is starting trials today, and tomorrow Mike is starting trials in Cleveland at the Cleveland Clinic for this therapeutic treatment of hydra. It's skipping my mind. It'll come back to me. Chloroquine and azithromycin cocktail, which in conjunction has shown in a French study, he sent me the study, that within 3 days, 90% of the people are not only better, but they stop shedding and spreading the virus. Within 5 to 6 days, everyone was better. He says we will have results for this from both New York and Cleveland on Wednesday of next week. And you'd have to imagine that President Trump would be very eager to get this information out. So you started with the stock market. And I would have to believe that if people found out that you can curtail this, you have a therapeutic solution, it's been tested, it's safe, because hydrochloroquine is a malaria drug that's already in the system. People have taken Z-Paks, that's already in the system. It's not a new drug that has to come out. He talked about how Bayer can ramp this up. His daughter works at DARPA, and we can get this produced in mass very quickly within about a 10-day period for people. Plus, we have some in stock. If this is possible to see that in the next 10 days, there's a big change in the progression of this virus, and he believes very firmly that in April, this virus will subside for natural reasons, as most winter viruses do. Something about the climate change causes that. Then he believes that we will have like a coming out party in the month of April, to which you'd have to think that the stock market would respond favorably to.
Wow. So, I mean, that we're talking about the month of April. So we're talking about this could potentially be within 30 days.
Yes. And that's why I believe that while the stock market today is rallying and it may suffer a pullback in between, there may be changes. I think that that there is reason for optimism. Let's put it that way. I think there is reason to be optimistic that we will see businesses start to come back. And Ivy Zellman, who's the #1 housing analyst in the world, I spoke to her yesterday, and she's like, look, we might see spikes in unemployment, but Ivy's very colorful too, and she says it like it is. You'd love her. She's wonderful and brilliant. And she's like, do you really think that Marriott's not going to hire people back? Do you really think Disney's not going to hire people back? So it won't be everywhere, but we will see a rapid beginning of a recovery that might take a while. And there's certain businesses that might struggle, unfortunately, but she is very optimistic that the bounce will be good. And she's optimistic about the bounce in the housing market as well.
So that was actually what my next question was going to be, is what are you, you talk to more leaders from independent mortgage bankers than anybody I know. You are friends with KP, you're friends with Casey Crawford. I mean, you're friends with everybody. What is the impact that you're seeing on the purchase market? Because, I'm getting mixed information. Some people are telling me there's devastation, and other people are telling me that they still had 50% of their locks yesterday come through as purchase. So what are you seeing?
So the lock environment can be a bit of a lag. Let's remember, so those transactions could be in place and now they're coming down to be locked. So I can understand that, but I think it's only natural, Anthony, as you're well aware, that you're going to see a slowdown in purchase transactions. It has to be, because if it isn't the appraiser, it's maybe not going to see an open house or this. I believe that in the long run, this will be a great opportunity, because you could finally stop being outbid for a home, and you could finally find a home to the extent that you want to do so carefully and proceed carefully, and that the seller would allow you to proceed carefully. I'm not saying it's without its difficulties to facilitate a transaction, but to the extent that you can, I believe that if you take the normal course of action, let's look at 2008 as a case test. If you purchased a home in 2008, it looked like you were making a big mistake, but if you forgot for a minute about the volatility that occurs day to day, week to week, month to month, and you say, if I'm purchasing a home, I'm probably going to be there for 10 years. And then you look back in 2018 or 2019, you did darn well on the purchase of that home. So I think people will look back at this time and the bit of a lull that we're seeing in housing, and where you might see home values drop a little bit, as a true opportunity. And dependent on how long the effects of the virus, and that's why I say it all comes down to the virus. If we have a therapeutic, everything else falls into place. The stock market, the housing market, the interest rate, everything falls into place. That's why it's so critical. And if that's the case, and if you believe that that's the case, I think you'll find housing will recover very well. Because let's remember, Anthony, a few key elements. And to answer your question in more detail, the leaders are saying, hey, look, we're focused on closing loans right now, and they could do that. And I want to talk to everybody about your key to the future is cash out refinances, because you do a lot of good. You help people, you consolidate their debts, you give them a cushion. You give them a cushion just in case of a rainy day, and people need that. So this is a key for you to do. Don't rate and term refi. Don't just refi. Cash out refi and help people and change their life and restructure their debts. Be their debt manager. But when it comes to the housing statistics, please listen carefully. Number one, going into it, on both new construction and existing home sales, we're at 13-year highs. Demographically, simply put, much more demand than existing supply. No matter how you slice it, there is more demand than supply. That's why there's no inventory. Household formations are still growing more rapidly than construction. And the fact that construction is now slowing through this period, it exacerbates that. So you will continuously have more demand than supply. And that's just a rule of economics that will support prices when there's more demand and supply. If you take a look at homes overvalued, let me give you 3 points. One, affordability is improving, not getting worse, improving. That's one. Number two, you have the ratio of home value to rent. This is a very important metrics that very few people discuss. Currently, home values, the median home price compared to the median rent, it's a value of 17. So if you take the annual amount somebody pays for rent, 17 times that, that's the value of a home. When you take a look at the last 40 plus years, the average has been a little over 16, about 16 and a half. So we're fairly valued. The peak when we got in trouble, it was 24. So we're nowhere near that. Then let's take a look at another metric that I like to use. Home price or home value to the cost to replace that home. It is currently 1.59. Over the last 40 years, the median's been 1.58. So we're right there. When did we get in trouble? When it was approaching 2. So if your home value was 2 times the replacement cost, that was probably too high. Average about 1.58, you're 1.59. So I think if we try to arm our customers with this, they will see that this is still a great opportunity, Anthony.
And I mean, I guess that this is just this conversation alone. If you're a loan originator, my recommendation would be, to watch this over and over again, because the information that you're sharing, like I just learned 3 things in that one, statement that you just made. So the fact that loan originators aren't taking that and sharing that with the realtors and their consumers, it's really, really important. It's like you just defined exactly why the market's not overheated and it's actually at a fair level. And to me, that's really, really important, because the idea that, home values are overvalued right now, based upon those data points is inaccurate.
And the thing to remember too, Anthony, is I'm not saying that home values won't decline during this period of time. Certainly the unemployment situation is troublesome. If this persists, we will be in for more heartburn, okay? And the housing market undoubtedly will see values decrease. What I'm looking at that as the opportunity as opposed to running away from it. So I believe that this is an opportunity only because a home tends to be a longer term investment. So Anthony, if you're saying I'm going to buy a home this year and sell it next year, I'd say, boy, I don't know. Okay. But if you're like the average individual who the median age in a home that they stay there before they sell it is 10 years, I think you'll look back at this in 2030 and say, man, I got a really good deal on that home and I did really well. I believe that wholeheartedly, that you will be very, very happy when it comes time to sell the home that you bought in 2020.
Yeah, and I think that's the same mindset you have to have when you're buying stocks too. If you're buying for this year or next month, it's short-term thinking is going to get you, in a lot of pain if you're caught in the wrong market. What are your we talked a little bit before we got started about what's going on behind the scenes. MSR, we have government lending. I shared some information with brokers about this as well. There's a lot of pain that's coming in that space. Last week we saw non-QM, that entire market disappeared, and it basically within one full week, unfortunately, because there are some really great people that you and I both respect that are in that space, but it did disappear, unfortunately. Right now, government lending seems to be under major pressure based on things that are happening in the MSR market. What are your thoughts on what you're seeing?
Well, I think that a big concern right now is that the unintended consequences of trying to do good. For example, when there is a forbearance that's put forth on mortgage payments, I get it. That's, we're trying to help people who want to do what's good, but there are unintended consequences. And one thing that most people don't know is that if you're a servicer in the mortgage industry, and we certainly need those servicers, right? So servicers have a covenant that they must pay the investor the money even if they haven't received it. Now, under normal circumstances, Anthony, that's not a big deal because 30-day delinquencies tend to be 3%, 3.4% in that range. So you can deal with 3.4% if everybody else is paying you, yep, and you have a little cash flow and you're accustomed to that. But if everyone stops paying you, how in the world is a servicer going to front that money? Now, you're only liable for 30 days, okay? So that there is a ceiling on that. But to the extent that you have not received a massive amount of that money, how are you going to lay that out to the investors? So I think that that's an area that needs to be worked out as part of some forbearance issues. And I get it that people need help, but we have to not tax one area of the system. And the other is we're seeing mortgage-backed securities rally today. They've rallied over the past few days. And while we like that, and that's primarily due to the inconceivable amount that the Fed is buying. Okay, the Fed is buying $600 billion a week, and they said that they would do it unlimited. Now, I just spoke to Danielle DiMartino from the Fed, and she's like, Barry, we cannot keep this up and not expect there to be some fallout out there. And the thing of it is that the Fed is kind of crowding everybody else out of the marketplace. And as rates improve, at least as far as mortgage-backed securities go, it puts many lenders who have to have hedged in an uncomfortable position because now their short carry becomes out of the money and they are going to be receiving margin calls. Actually, when rates went up, it helped alleviate that stress.
Yeah.
But now it's causing it, and there's long-term ramifications. Are we going to be able to, in the future of our industry, see less than a 12-month early payoff criteria? Are we going to be able to lock loans for 60 days and not have it shortened to maybe 30 days? These are things that may change the future of our mortgage industry going forward.
Yeah, Barry, those are some really great points because that is I had a call last night with 20 or so leaders of different lenders, and this subject came up in a big way. And I'm happy that you're sharing this information because of this volatility. I'm not saying this is going to be the forever situation, but lenders have been hurt so badly over the last 2 weeks that you're going to see lenders start to say, hey, listen, Mr. Loan Originator, when you get your loan to approved or you get your loan to clear to close, now you can lock. And it's not a channel specific situation. It's going to impact everybody because of the fact that exactly what your point was, which is things are changing so quickly that you go from being in the money to out of the money. Last Friday, people were celebrating. Yesterday, people are jumping off buildings. It happens that quick. And at the end of the day, I try to express this to loan originators. It's really important that even though these changes are impactful to us and our consumers and real estate agents and everything, the thing that's in the best interest of everybody is staying in business. And we don't want anybody to go out of business right now in any channel. It's very important that everybody serves consumers.
And Anthony, you're so right. And if you'd like, Anthony, I could try and so everybody understands this. And I know many people understand this, but there might be some that don't.
Yeah,
if you'd like me to explain the mechanics of how this works so we can all understand why this is so critical. And then, Anthony, I mean, just imagine this for a second. If you can't lock a loan until it's approved or until it's in closing or or clear to close or in underwriting, any of those that doesn't allow you to lock at application, whether it's just a 30-day rate lock or whatever it is, imagine the bad actors out there who then would have a license to say, yeah, my rates 1%, come to me. And then by the time you are able to lock in on an even playing field, now it's gone up to 4.5%. I worry about, it's like a Rubik's Cube. You turn the thing one way and you expose a problem the other way, right? So
Yeah.
the further down the chessboard you think, the more problems that potentially arise. And that's why we are at such a critical juncture and why we have to think things through beforehand. So Anthony, here's the mechanics of this that's very important for all of us to understand. So the problem that you see is that lenders have capital that's very important, and they have to have a specific amount of capital, and then they can lend a multiple of that capital. It's really the way our whole banking system works. And so if part of the assets that you have that are counted towards capital is your servicing portfolio, well, the servicing portfolio has a value. And the way it works, like the easiest way I can explain this, Anthony, is if you think about it, on a transaction that you're servicing, it kind of pays off as if you paid like points on a mortgage if you were a borrower. So if you said, hey, look, I'm going to pay a point on a mortgage, I'm going to buy the rate down a quarter, and it takes like 4 or 5 years to break even. Well, if you keep that loan longer than 4 or 5 years, you made money on that deal. If you refinanced it in a year, you lost money on that deal, right? Well, using that premise, if you're a servicer, let's say the value of that servicing is 1.5 points. And you wind up now where if you're getting 40 basis points, it'll take you about 4 years to break even. So if that loan stays on the books like it normally does for 7 years, you made a lot of money. But if people are refinancing in a year, you lost a lot of money.
Yep.
And because when rates came down, people started refinancing faster and faster and faster. The servicing value went from 1.5 because nobody's going to buy that from you at a point to, let's say, a point. Now, if your assets that you had in servicing drop that much, that means you have less that you could borrow against. So that's your first issue, plus you're losing money on it. Okay, we got that. Plus, how about all the money you're losing on all those loans that paid off? You paid 1.5 or a point to get it. You only got 20 basis points because it was on your books for 6 months, or 40 basis points because it was on your books for a year. You lost 60 basis points. So that hurts your bottom line. And then in addition to that, you have the margin call. And here's the margin call couldn't have happened at a worse time because your assets are dwindling.
Yep.
And now you have to come up with cash. So how does that work? If you lock somebody in at 4%, when you lock somebody in at 4%, it's not like it's magically locked. It's still floating. What it really is, it should be called, I promise to give you 4%. It's not a lock. It's, I promise you. The lock only occurs when that loan is sold, and then it's in the market in a security at 4%. So what happens is there's fluctuation, as you well know, Anthony. The market would go up or down. So if the market went to 4.5%, well, come time to close, I got to buy it down to 4% to uphold my obligation to the customer. So I got to buy it from 4.5 down to 4, which costs money. Since I don't want to risk that, I do something. It's a term everybody's heard of. It's called hedging it. So how do I hedge that? I want to have a security that I invest money in that makes money for me as interest rates rise or as mortgage-backed security prices go down or worsen. So I short mortgage bonds. And there's ways that you could do this. You get what they're called, you to be assigned, but for conceptual purposes, I'm betting that if mortgage bonds go down in value, which causes rates to go up, I'll make money to the extent that I can now pay to buy that rate from 4.5 to 4. So I walk out of this pretty even, except for the cost of doing these trades. Okay, so it's a good system, and that works. But something funny happens when rates drop. When rates drop, the same mechanism in the opposite direction. So now my short, if you shorted anything, if you shorted Apple stock, yep, and you watch the price go up, you're losing money.
Yeah.
Now, the offset for that, Anthony, is that as the rate went from 4% down to 3.5%, when I close this loan, I stand to make a lot of money to offset my loss in the short, which seems great on paper, but there's a handshake issue. There's a timing issue. You see, I got to wait for that loan to close to collect that.
Yep.
The broker dealer, once I go negative about $250,000, to say, excuse me, give me my money. I want it now. And you say, wait a minute, look at all this money, Anthony, I'm going to make when I close this loan. They say, sorry, I'm not waiting for you to close it. I don't know if you're going to close it. That's your problem. Give me the check. So when rates come down precipitously, when mortgage-backed pricing rises dramatically, like we're seeing in the last 3 days, those margin calls start coming. And that's what's so darn awful about where we are. The only way to solve it is don't take loans or don't take locks, or at least shorten the lock period. And that's why we're seeing this mess.
Yeah, you just summed it up, and I would just say that if everybody just takes a step back and listens to what Barry just said, and if you just play back the last 3 minutes, think about either if you're a loan originator that is for a retail lender, think about how you've seen things change on the way your lender your company is pricing things and the way that their price fluctuations have been. If you're a broker, obviously, think about how our lenders have changed, and we've seen lenders go completely out of the market. We've seen them come all the way back into the market. We've seen lenders on Monday aggressive, then Tuesday not. I talked to a lender that on Friday, like I had shared, everybody was in a great mood because rates came in favor of the lenders and their margin calls. Yesterday, that same lender, and this is just a top 5 wholesale lender, not even like number 1 or number 2. They told me that they were looking at $80 to $100 million margin call. So that means Monday, market makes this movement. Tuesday, you got to send a wire out for that amount of money. And again, you're going to get it back when you close the loans, assuming you close them. If you don't, then you have an issue. But the reality is this: the money still went out, and now you have a cash crunch.
And Anthony, to your point, exactly what you're saying. If we look at the market right now, we're up 147 basis points. That's great for originator to do a transaction. It's great to see pricing improve, but it's quite frankly, it's a nightmare for your margin call situation right now. It just exacerbated exactly what you were saying, Anthony.
And Barry, does that compound? So hypothetically, like we've seen MBS, I mean, it's been crazy this last week. So let's just say Monday, you lock in your rate. Tuesday, 100 basis point swing. Then that gets compounded by another 100 basis points on Wednesday. Then another on, like if it keeps getting worse, are you continually stroking checks or wiring money as that price worsens?
Yes. You will get a daily margin call, and that could be very trying, especially, Anthony. Think about, to your exact point, when you use the word compounding, you're correct. So, because think about this, unfortunately, many of us are trying to battle this virus, and therefore we're working at home, which means we're definitely going to be less efficient. Appraisers are taking longer. So we can't get these darn loans closed fast enough, right? And that's why this is a dangerous situation. So please, everybody who's listening, please, I know that you have your client's best interest at heart, and God bless you for that. But for the health of our industry, please don't pull transactions from one lender to another. Please do what you can to submit good files and get these things closed, because we have to all unite here. We have to work as a team. And this is the time for us to really stand behind each other and make sure that this industry, which is so good to us and does so many good things, is healthy for the long term.
Yeah, I honestly, this is you just hit the nail on the head, and I learned this lesson in the last 2 weeks, and when back, it's only been 2 years, but at Garden State, when we'd see shifts like this, and we would literally take a pipeline and move it to another lender. At that time, I didn't understand the implications. I just thought it was, hey, we took it from here. Maybe you had to pay for some appraisals because, the consumer already paid for an appraisal. But your upside was you're getting the consumer's better rates, you're making more money, whatever. It's so much bigger than that right now because every LO is doing, like if you move one loan and every LO is doing that, that has the ability to literally cripple a lender. And right now, I think what Barry's message is, and I support it wholeheartedly, is we got to take this 90-day period of time or however long that we're in this extreme volatility. And we just got to say, what's most important to the industry, to our families, to our communities is getting through it and being on the other side of this and being in a situation where we can still use the same wholesale lenders we used to love and work with. Everybody is able to do the loans. Non-QM comes back. But right now, sacrifices need to be made and the low-hanging fruit need to be ignored because it's in the best interest of our industry, and it's in the greater good of all of us because everybody's feeling pain. Nobody is sitting there happy right now. I mean, like, rates are great, but very painful times for lenders.
Yeah, and we're talking about, listen, I don't want to. I was a broker for a long time, and I know the pressures you're under for your customers. So God bless you. I appreciate everything that you do, and I know the struggles that you have. But if a loan is locked, please, in this time, please do what you can to keep it where it is. Please do not move that loan. Please resist the urge to do that. And Anthony, listen, I just have to say this because I'm so proud of what we've done at MBS Highway. While a lot of people were locking everything that came in, we did not do a rate lock in 2020 until March 9th. Okay, so lenders that had all their people on our service continuously thank me every day because they were not in a situation where they were underwater because the market moved up and their shorts caused them margin calls. So it's really critical, team, that you use correct judgment when you lock a loan, and that's very, very important. It's important for the health of our industry, and I think it's critical that, and this is not in any way, shape, or form saying you have to use MBS Highway, but you really need to be on board with looking at the market yourself in a way that you can understand it and make correct decisions as to how to proceed with your customers.
No, I think, Barry, really just so your point, I think MBS Highway, guys, this isn't a shameless plug. This is more or less like you're an expert. And in order to be an expert, Barry's doing these interviews, and it's great because at this volatile time, we're getting his attention for an hour here, and it's wonderful. But understand, like, that needs to be a required part of your toolbox. Like, you need to know what an expert is telling you to do based upon market conditions. Like, just like our consumers aren't experts on loans and rates, and we have to educate them, we need to listen to this expert on a daily basis, not just in this market volatile situation. So I can't recommend it high enough more. And all the companies that use it, it's one of those things that they don't look at as expendable. It's a required tool for their loan officers.
They do, and thank you. And the thing of it is, team, is please be careful with the other ones that are out there that don't understand it. I mean, everybody tells me what's going on. They send me stuff. There were literally the vast majority, if not all, the other services are out there. We're telling everybody almost lock every single day in 2020. Almost every single day, lock. And they buried our industry. And obviously buried you guys, because the problem with that is that now you got to renegotiate with the customer as rates got better and this, that. So it is really, really, this is a critical time to truly be an advisor and to have the expertise that is required of somebody, as Anthony said.
So Barry, thank you. And again, strongest recommendation I could possibly give to everybody is making that investment. I don't even look at it as an investment. I look at it as just a required expense. Moving on, we've covered, the MSR market, how government lending is potentially going to be impacted. Right now with the stimulus bill that's coming up the pike and some of the things that are coming from a legislative perspective, can you walk us through, how is that going to help, Joe Smith, Mr. Main Street, if they have a small business and their entire team is currently unemployed because, they are shut down?
Yeah, it's not going to come back super fast, but it will come back, and maybe it comes back a little differently. But this creates a whole other set of challenges. Anthony, I think that in a short 2 days from now, we're going to get some very scary numbers for initial jobless claims that could approach 2 million. 2 weeks ago, the number was 210,000. Last week, it was 280,000. So that's a pretty significant jump. But could you imagine if it goes to 2 million? I don't know, but that could potentially be. And if it doesn't get that high, John Malden, who's, again, one of the smartest people in the world financially, him and I are dear, dear friends. And John says to me, he says, Barry, I got to tell you something. He says, I am hearing stories about these initial claims benefits. They're crashing systems in different states and different areas because they can't handle it. So the number we see on Thursday may understate the dire situation that we have with the level of unemployment. So, please, everyone, I know that you have issues currently and heartburn that you're dealing with, but God, we have to be so thankful of the fact that we have work. And our problems are very different than somebody's problems who isn't working right now. So, just keep perspective and have a little patience with everyone there, and just know that you're in a fortunate situation, even with the problems and challenges that we have.
Yeah, I just on that, I got a haircut yesterday, and the barber shop has 2 locations. They have close to 100 employees, and it clicked for me when he told me that all of his employees are filing for unemployment this week because Philadelphia or Pennsylvania just put a shelter in place in order. that's massive when you think about that's just one business. And then you talk about all the other businesses. I think 2 million might be low. I mean, considering how impactful this, I mean, we're talking about New York City, we're talking about Los Angeles. Like, I don't know, it's scary and it's unfortunate. And obviously, you know, hopefully we can get through this as quickly as possible.
You know, Anthony, you're so right. And when you think about the highest we ever have seen in our country was 600,000. Even at the worst part of the Great Recession, it got to 600,000 claims, which was devastating. The unemployment rate during the Great Recession was 10.8% at its peak. When you take a look at the Great Depression, it was between 20 and 25%, and that was awful. You see the black and white pictures, right? That was kind of an awful, awful time that scarred us. But team, here's the thing, is that Stephen Mnuchin threw out a number of 20%, and not to be outdone, St. Louis Fed President James Bullard this week said he sees 30% unemployment. And who knows even if that's a low number. So that's why I say everything depends on getting this virus corralled. Because the sooner we get this corralled, the sooner we can go back to work, and the sooner that things start to come back and fall in place. And we just got to pray that you know, there's a solution for us there. Because quite honestly, team, if it persists for a long period of time, currently we're immune. Right now, when on a business level, we're immune. Okay. Currently, we are busy. We're working. We can do so much good. We could help people. We could do cash out refinances, give them a cushion, lower their debts. We can do so much good out there. But there will come a point where, if the shutdown persists, that we won't be immune from these effects. And that's why it's so imperative that we find a health solution, a medical solution. And that's why I'm so optimistic and so hopeful. That's why I talk to Dr. Roizen 3 times a day, and I bother the poor guy to get every update I can, which I continue to try and help share with you so that we can know what's going on. He spoke to the doctor who ran the French study, and he sent me a copy of the French study. It made me so happy, because while it was a small study, everyone got better in 5 to 6 days. 90% of the people got better in 3 days. Anthony, if that happens and we do get confirmation of this next Wednesday, you know, in Dr. Roizen's words, we will have a coming out party. It'll be a celebration here in the U.S. So pray to God that happens.
Yeah, absolutely. Barry, on the perspective of loan officers, and I know, you know, some people who watch this might be Barry and Anthony are beating up loan officers. We're not. We're just trying to translate what's happening. And for me, you know, I was just a loan officer during the financial crisis. Barry, you were an expert in the industry at that point. You know, a lot of loan officers didn't know what was going on. It was all happening behind the scenes. And by the time we heard what happened, we were reading it in books years after the crisis. Right now, we have a health and a financial crisis playing out in front of our eyes. And at least from the financial perspective, Barry is obviously the leader on this, but I'm trying my best to also bring information to loan originators so they understand what the troubles are that are going behind the scenes. And one thing I've asked loan officers to consider is, you know, making less, you know, potentially doing loans, you know, I'm not saying work for free, but understanding the environment, understanding where rates are going to be as soon as the industry does start to adjust and stop protecting EPO situations, to protect themselves, to protect their companies, because, you know, at this point, consumers are watching. They do want better deals, and at this point, closing at max comp or anything like that is just it's not really feasible. So, what are your thoughts on that side of things?
Boy, education. First of all, you're so right, and you certainly are a great leader in doing this, Anthony. So, for the first thing is let's educate the consumer. Let's educate the consumer that there's a big difference between the Fed funds rate and mortgage rates. And you know what I'm going to do, Anthony, is I'm going to ask Diana or Megan to put in your hands a valuable chart that shows the difference. So I will make sure that I do that so that everybody on this call can have it to share with their customers.
Thank
because
you.
when you see the difference, you'll see they're not really related. And what the Fed is really trying to do is to protect our banking system so that when you go to take your money out of the bank, it doesn't seize up on you. And it's not like in the movie It's a Wonderful Life, where you can't get your money. So that's what the Fed is really trying to do. So that's the first thing. And then there are constraints that we will be looking at, the constraints that we discussed, from margin calls to servicing devaluation to the fact that we are trying to get transactions done with skeleton staffs that are working from home, that are facing other difficulties that happen during this process. So I think this is a time to appeal to everybody's inner sense of the greater good right now, and that your customer's not immune from that. And you have to just kind of have that very frank conversation with your customer right now. Show them that there's differences. Tell them that it's the truth. You want what's best for them. You're working very, very hard. And listen, you guys, you got to almost feel like you're on an island there, right? You turn one way and the realtor's giving you crap. The customer wants things that are unrealistic that they're giving you crap. And then you go to get something from a lender or a wholesaler or your company, and I'm not saying they're giving you crap, but they have a hard time accommodating you. Okay, they want to, but they're having a hard time because of what they're facing. So this is just the time that your character has to rise above this. In this time, this is where people show their character, and you say, listen, I know it's tough all over, but I'm bigger than this. I'm better than this. I'm going to be patient. I'm going to have grace, and I'm going to do my best to be educated just like you are from being here, and explain this to people in a way that hopefully they understand. Not everybody will. Not everybody will take it well. Don't take that personally. And remember, this isn't your fault. You didn't create this virus. You didn't create these crazy times. It's not your fault. And I know you take it to heart because you want to do good, but don't make it your fault. Understand that this is out of your control. And when you explain it to your customer, please explain that this is out of your control.
So I talked to Barry. That's all 100% accurate, and I support that message. It's so important. It's so important that everybody understands that this is real, and we have to be compassionate. On that note, I talked to a friend of mine who works for a major retail lender, and he's a branch manager, and he had told me that processor had called him yesterday afternoon and said, hey, just so you know, we have 35 closings scheduled for next week, and we just reached out to do VOEs, and half of them are out of jobs. So, I think a lot of people are kind of taking this position like, hey, let's just get them closed. Let's bend the rules. Let's see what we can do to get this closed. The one message I really want everybody to understand is fraud needs to be off the table. And I'm not going to assume anybody's committing fraud, but you have a consumer that wants to close. You have, hey, they have a job, but they're not working. We're not paying them. That when the VOE comes back saying that, it might in your head sound like, oh, we can fudge the numbers, or we can fudge this, and no big deal. They're going to have their job in 60 days. The problem is that we are going to have, defaults are going to happen. And eventually when that does happen, there's going to be reps and warrants and defects, and lenders are going to have to pay a price for it, and investigations are going to happen. And you don't want it on your reputation. You don't want the penalties, the fines, the potential criminal investigation. It's not worth this compensation. It's not worth the commission on this deal. It's not worth anything. And I think, Barry, you can probably say the same thing, that we need to really, really understand there's no little, hey, it's just for this one customer. We can't do it. It has to be off the table.
Anthony, God bless you. That's so true. And once again, listen, team, I'm one of you. Anthony's one of you. It's not like we're sitting in some ivory tower, and we don't think we don't know what it's like to come under pressure from a client, from a real estate agent, from your own financial needs. But while it's always improper to do, right now it's something that you just have to you just show your character. I know inside of all you guys, you want to do what's right and the good things. So just rise above it. Don't capitulate to the external pressures that are out there. It's really important for the long run. We just have to think long term here. Look, I believe in my heart, Anthony, I believe in my heart that we're going to get good results next Wednesday. And I think we're going to start to go back to work sooner than people thought. And I believe in my heart that we are going to be in a better position, and we're going to have these calls together, all of us, and it'll be a happier time for us. I know that that's going to happen. Okay. So please don't think over just the short term. Please think that we need you to be in a great position for the long term, because this industry it's critical to our economy, and it's critical to the way we do things. And we don't want fallout like we had after the 2008 thing, where the bad actors, a few bad people, caused Dodd-Frank to make our lives really miserable.
Yep.
The way we have to do business is much harder. So listen to what Anthony's saying here. I think that he's spot on.
Barry, we've gotten 45 minutes of your time. I know you have other appointments. I just want to, give you an opportunity. Anything else that you want to convey to our audience about what's going on in the market, or anything that you're forward thinking towards?
Well, when you have these situations and these circumstances, it provides you with opportunities. And each and every one of you now have an opportunity to get on social media, to educate others, to calm people down, to let people know that there is reason to be hopeful, not just pie in the sky hope, but there is reason to be hopeful, to think about the fact that there could be some buying opportunities, maybe in the stock market, certainly in the housing market, that arise because of this. So if you think of all the folks that are amongst the most successful in the world, in our generation, Warren Buffett certainly is a name I think we've all been accustomed to as one of the people that have been able to become extraordinarily successful. One of his mottos is be greedy when others are fearful and be fearful when others are greedy. So this tells you that right now, while many people are fearful of what's about to happen, this could be your chance to not be greedy in a bad way, but to teach others that there are opportunities, to be in a position where you use this period of time to be a leader and use social media, use the educational platform that you have to help others get through this. I think it will come back and it'll first make you feel good, but it'll also allow you to really prosper from it as well in the long run. And that's what I want everybody to focus on, is in the long run. I mean, listen to Sir John Templeton, one of the people that I listen to financially for a very, very long time, would say that you want to be a buyer on the most pessimistic day and a seller on the most optimistic day. There's reason to see a lot of pessimism out there, which tells me that right now could be an opportunity that we look back on in the future and say, I'm glad I did that. I'm glad I invested that way in myself, in assets, because I am definitely seeing that was a very good time to take advantage of it.
Agreed completely. And that's not just about buying stocks and buying investment properties. It's also in your businesses, understanding that, somebody reached out to me over the weekend and said they were thinking about laying off their whole staff. And I just said, let's take a step back. We're going to get through this. And when we do, I don't want to say there's a gold rush, but there's going to be a big opportunity for mortgage team originators. Now's not the time to subtract. Now's the time to have responsible conversations with our teams. If there is some concerns financially, and do what you need to do to get through this. But on the other side of this, there's going to be big opportunity, and being ready for that is really, really important. Barry, one last thing. I know Dan Habib's birthday was this weekend, so please, everybody, happy birthday, Dan. We appreciate him as well.
Anthony, thanks so much. That's so nice of you. I'm proud of my boy. I really am. And can I just tell you what a crazy kid this kid is? I think he's got my genetics. So Dan had torn ligaments in his ankle. So what does he do? He goes for surgery during the day. But do you know he's right back at work that afternoon? He's answering emails. He's like, I mean, that's hard.
Chip off the old block.
Well, you know what? I got to raise my standards to live up to what he's doing. But if we all have that attitude of wanting to help each other, and please think that way, everybody. Just think about, don't think about, what can I get? Think about what can I give.
Yep.
And if we all do that, we're going to come out of this thing in such good shape.
Agreed. You're leading by example, Barry. We appreciate you very much. Thank you for being the chief economist for the entire loan originator community. We appreciate you.
Thanks, brother. Thank you. God bless all you guys, and be well and be safe.
You the same.